I was at a dinner party last week, and the guy sitting across from me couldn't stop beaming.
Oh, God.
Yeah. He was scrolling through a real estate app, showing me how his suburban 3-bedroom had earned more in equity this year than he had from his actual salary.
Wow.
He was practically giddy talking about this genius move to buy when he did. And to him, I mean, those rising numbers on a screen were just ironclad proof of his own financial savvy.
A sign that the system was working for him.
Exactly. But then the conversation shifted. Someone mentioned the rising interest rates on car loans and the fact that his grocery bill had nearly doubled in 18 months.
And let me guess, the mood changed.
Just like that, the glow vanished. His expression soured, and he immediately starts venting about greedy corporations and incompetent politicians.
Of course.
He was furious about the cost of living, but he seemed completely oblivious to the fact that the same invisible hand that had artificially inflated his home value was the exact same one now reaching into his pocket at the checkout line.
A striking contradiction, isn't it?
It really is. He was celebrating a win while being slowly crushed by the very same mechanism, yet he couldn't name the institution responsible if his life depended on it.
And he's not alone in that.
No, he's like most of us, living in a world where the price of his money, the fate of his debt, and the value of every hour he works are decided in rooms he will never enter by people he will never vote for. That instantaneous shift from the, giddy excitement of paper wealth to the furious condemnation of its consequences, it just made me realize how little we understand the referees of this game.
We treat inflation like bad weather.
Yeah, and house prices like magic.
Yeah.
We ignore the architects who can create wealth out of thin air or erase it overnight with a single press release. Once you see the hidden power behind the curtain, you realize that the stability we're promised is, well, it's often just an illusion designed to keep the machine running, regardless of who gets caught in the gears.
And that is the central paradox we are diving into today. You just perfectly described the giddiness over the paper wealth effect, which is really just a revaluation of existing assets versus the fury over the real-world costs of those actions.
It's a total disconnect.
It is. When the financial machine is humming, we celebrate it as personal acumen, our own genius. But when it extracts a cost, we blame these, vague external forces.
So our mission in this deep dive is to pull back that curtain.
Exactly. We're going to unmask the hidden power of central banks and monetary policy, not just by looking at interest rates, but by analyzing the 3 structural consequences you, the listener, feel in your daily life.
We're talking about the price of money.
The price of money, the fate of debt, and the value of labor. Because these are decisions being made in unelected rooms that shape the entire landscape of modern life.
So what's first?
First, we'll examine the structural erosion of meritocracy. This idea that hard work, well, it no longer guarantees upward mobility. It's a story about who gets new money first. Second, we're going to look at the destruction of market discipline. Why bailouts seem to reward recklessness and punish prudence, leading to this kind of artificial stability.
And finally,
we'll analyze the quiet dissolution of family stability and intergenerational security caused by the silent tax of inflation. We really need to understand this system to position ourselves outside of its predictable cycles.
All right, let's unpack that first consequence then. This feeling of merit fatigue. It's a profound sense that the traditional rules of the economy, work hard, save diligently, climb the ladder, they just don't seem to apply anymore.
The ladder's been replaced.
It feels like it's been replaced by a hidden lift, one that only goes to certain floors.
That's a great way to put it.
To illustrate this, let's go back to a story we were looking at, the story of David. David is a senior civil engineer in a thriving metropolitan area.
A highly skilled, productive professional.
Absolutely. He spent 2 decades mastering complex infrastructure projects, believing that his specialized productive labor was the key to financial security. His income grew steadily, tethered to productivity gains, maybe 3% annually.
Which is the traditional sustainable model of career growth.
Right. But as this era of vast monetary expansion took off, the one we saw post-2008, and then it accelerated like crazy in 2020, David watched a cruel decoupling happen. The price of the modest family home he wanted to buy jumped 50% in a very short cycle.
And not because the home was suddenly 50% better or more productive.
No, not at all. It was driven by institutional money inflows and these ultra-low borrowing costs. Right. Now, you compare David to his neighbor.
Okay.
This neighbor is a junior special purpose vehicle coordinator at a large private equity firm. This neighbor grew wealthy and rapidly, not necessarily through building anything tangible.
By being positioned correctly.
Yes, simply by being positioned close to the source of new liquidity. His job was moving financial paper around. And David's tragic realization was that no matter how many bridges he engineered, he could never outpace the speed of the printing press.
And that is the core of merit fatigue. The traditional reward system for real labor has broken down.
It feels broken.
David's frustration is precisely what the Cantillon effect explains. It's one of the most important yet least understood economic concepts that directly governs modern life.
Cantillon effect, so named after
Richard Cantillon, an 18th century economist. This effect describes how an increase in the money supply does not spread evenly across the economy.
Right, it's not like pouring water into a pool.
Exactly. It occurs in stages. It flows into specific sectors first, effectively choosing winners and losers based on their proximity to the source of the new money.
So it's not just that the money supply increases, but where that new money first lands that matters most.
That's the entire game. When Cantillon first wrote about this in 1755, he described the process stemming from, say, the discovery of new gold or silver mines.
Okay, a tangible example.
A very tangible one. Who benefits first? The mine owners, the refiners, the smelters, and the local merchants near the mine. They get the fresh metallic money, and they use it to increase their consumption. They buy better clothes, better food, fine wine.
Before prices have gone up for everyone else.
Precisely. Because they are the first to spend the money, they get to enjoy that higher consumption before the general prices of goods and services have fully inflated. By the time that new gold finally filters out to the distant laborers or the farmers or fixed-income workers,
It's too late.
the prices for everything they need have already been bid up by the early recipients. So the late recipients were essentially paying full inflation price for goods, while their own income hasn't caught up yet.
That makes perfect sense for gold mines. But how does that apply to our modern system, where money is just created electronically by a central bank? How does the special purpose vehicle coordinator, the neighbor, get the fresh money before David, the civil engineer?
That is the critical modern mechanism. Today, the central bank is the mine, and the mechanism for distribution is the financial system itself.
I see.
So when a central bank engages in massive asset purchases like quantitative easing QE, the new liquidity is injected directly into the financial system. It does this by buying assets, primarily from major financial institutions, often called primary dealers.
These are the big banks, investment firms.
The biggest. And this new money, it doesn't filter through the labor market first. It doesn't go to David. It flows through the capital markets. The financial industry receives the money first, and what do? They bid up the prices of stocks, bonds, and real estate, the very assets they hold and trade.
So David's neighbor is standing right at the mouth of the spigot.
Right at the mouth of the spigot. The financial services sector, high-tech, asset owners in general. David, the engineer, whose income is tethered to a salary negotiation based on his labor output, is at the very, very end of the line.
So the immediate consequence of this mechanism is just staggering inequality. The money hits assets first, enriching the asset owners, before it ever hits wages. And that leaves people reliant on labor to bear the higher costs later.
That's absolutely right. And it's why a lot of major research points to credit creation as a core driver of modern inequality. Those closest to the source, the financial elite, those holding large portfolios, they see their wealth, and sometimes their incomes rise first.
And the losers are everyone else.
The losers are those furthest away. The fixed salary employees, pensioners, workers on long-term contracts, they suffer because they have to pay the newly elevated prices generated by the early recipients.
It's a transfer of wealth.
A huge one. The economist Thomas Mayer specifically argued that excessive credit creation, whether from central banks or private banks, disproportionately benefits borrowers who already have collateral.
Meaning the rich get richer faster.
Exactly. And this effect might be more structurally relevant to rising inequality than some of the more traditional factors we always hear about, like globalization.
This analysis brings us directly into the era of unconventional monetary policy, or UMP. After the 2008 crisis, when interest rates hit the zero lower bound, the ZLB, they couldn't cut them any further, so central banks had to get creative.
And quantitative easing became the defining policy of this era.
Right. So what does the data tell us about how UMP actually differs from traditional policy?
This is where the deep dive into the research becomes so important. We have specific data comparing the effects of UMP shocks. So think of the QE programs from 2009 to 2016 against conventional monetary policy, or or CMP shocks from the pre-ZLB era.
Before 2008, when they were just adjusting interest rates.
Correct. And what's surprising is that the aggregate effects, meaning the overall stimulation of the economy, were actually pretty similar.
Really? I would not have guessed that.
I know. Both UMP and CMP shocks led to comparable, measurable drops in interest rates, although UMP's effect was a bit slower, more persistent. It reached a trough of about 45 basis points almost a year later.
But both stimulated the economy.
Critically, yes. Both policies stimulated industrial production, peaking around 2.8% at maximum, and both helped reduce unemployment. So on paper, if you only look at GDP or jobs, they look like pretty substitutable tools.
But the devil is always in the D-types, isn't it? And the detail here must be distribution. The aggregate economy might look better, but who is capturing that benefit?
Precisely. The distributional effects are radically different, and this is the entire story of the erosion of meritocracy.
Okay, lay it out for us.
When the Fed used conventional monetary policy, just cutting rates before 2008, the data suggests that those CMP shocks tended to reduce wealth inequality.
Reduce it.
Yes. 2 years after a typical CMP shock, the share of wealth held by the top 10% actually fell by a small margin, about 1.2%. It diffused the wealth just a little bit.
Okay, so what happened when they switched to unconventional monetary policy, to QE?
It was a complete reversal. UMP shocks sharply increased wealth inequality. After a UMP shock, the share of wealth held by the top 10% rose by a maximum of 1.5%.
So one policy slightly reduced inequality, the other radically increased it.
That's the takeaway. Traditional policy, maybe unintentionally, reduced inequality. Unconventional policy radically increased it.
So why? Why does this happen? We know the mechanism is the asset price channel, but let's break that down. What is the fundamental difference in how QE affects asset prices compared to a traditional rate cut?
The key difference is its impact on the stock-to-house price ratio.
The stock-to-house price ratio.
When the Fed performs a conventional rate cut, it tends to lower borrowing costs across the board. This is often pretty good for the housing market, right? Mortgages become cheaper, and it might support stock prices. But the ratio, the stock-to-house price ratio, tends to remain stable or even fall a little.
Okay, so it affects both more or less equally.
You could say that. But when the Fed engages in UMP, buying long-term bonds, injecting vast liquidity directly into the financial system, it disproportionately boosts stock prices relative to house prices.
Why, though?
Because the direct and immediate beneficiaries are the massive financial institutions and corporations. Their balance sheets benefit from easy financing, and investors, now flush with all this new liquidity, are buying up their stock.
So we have two different buckets of wealth here.
Exactly. Think of household portfolios. The wealthiest 10% of households hold a substantial, a very sizable fraction of their total wealth in stocks and corporate bonds.
And the middle class.
The middle 40% of households, however, hold their wealth predominantly in housing, and it's often leveraged with debt.
Right, the family home.
So when UMP hits and the stock-to-house price ratio soars, and the research shows it increased by a stunning 13% at its peak, wealth is fundamentally redistributed upward.
Because the value of the assets held by the top 10% skyrockets compared to the primary asset held by the middle class.
It's a massive financial reevaluation, driven purely by the central bank's choice of policy tool. It's staggering.
So you're saying that the central bank's actions explain almost half of the middle class's declining wealth share?
Up to 44%. Up to 44% of the middle class's declining wealth share can be explained by this specific reevaluation of assets.
Wow.
So David, the engineer, he was absolutely correct. The system was rigged against him, not because he wasn't productive, but because the mechanism of liquidity injection favors financial assets over the slow, hard-won equity that's built through labor.
It makes the traditional economic ladder almost irrelevant for anyone who didn't already have assets at the starting line.
That's the reality it creates.
If the Cantillon effect structures who wins in the economy, then I guess our next point has to be about what happens to the rules of the game when the winner is protected from failure. This takes us to the destruction of market discipline, the move from the central bank as a sort of neutral referee to an active player on the field.
A very active player.
I think about that story of Julian, the owner of that multi-generational furniture workshop in the Midwest.
Right, a classic case.
Julian embodied market prudence. He kept zero debt, he scaled his business organically, and he stockpiled reserves, fully prepared for an economic downturn. He believed in the creative destruction of the market.
The recessions weed out the weak and allow the strong to consolidate and grow. A healthy, if painful, process.
A healthy process. Then came the 2020 economic storm. And Julian watched his largest competitor, a debt-bloated national chain that was structurally insolvent after years of financial engineering and stock buybacks.
You watch them get saved.
He watched them receive a massive systemic lifeline, a therapeutic intervention, as it was called. Julian's hard-won prudence was basically penalized. He was struggling to compete against a resurrected, non-viable competitor.
So the core lesson of the market, that recklessness leads to bankruptcy, was suspended.
It was completely suspended. Julian saw moral hazard rewarded with a bailout, and it was suffocating his disciplined, debt-free operation.
Julian's experience is the textbook definition of the betrayal of prudence. And this shift, it has accelerated dramatically since 2008, moving central banks into an activist role far beyond their historic mandate.
So what was that historic mandate?
Historically, the core function of a central bank during a panic was to act as the lender of last resort, or LOLR.
LOLR.
For centuries, this role followed Walter Bagehot's dictum. The central bank must lend freely, but only to solvent institutions, and importantly, at a penalty rate.
That penalty rate, why was that part so important?
The penalty rate was essential. It ensured that borrowing was painful. It encouraged institutions to self-regulate and maintain prudence, which limited moral hazard. The goal was to inject liquidity, not confidence in insolvency.
But that model has clearly been abandoned in recent crises. We've moved from lending to solvent institutions at a penalty rate to, well, lending to practically anyone at incredibly subsidized rates.
Even those who should have failed. The expansion is crucial to trace. The Fed's LOLR powers were expanded back in 1932 via Section 13(3) of the Federal Reserve Act. That allowed emergency lending to individuals and non-financial corporations, but it was strictly defined as limited to unusual and exigent circumstances.
A high bar that was meant to be rarely crossed.
A very high bar.
Yeah.
The 2020 response, however, was the defining moment for what you might call mandate creep. Section 13(3) was deployed again, but this time the Fed entered the corporate bond market.
Unprecedented.
Completely. They established the primary market corporate credit facility and the secondary market corporate credit facility. And this was an action aimed at supporting entire asset classes. And here's the most critical detail. They purchased corporate bonds, including those rated as junk or fallen angels, companies that had recently been downgraded to below investment grade.
So the central bank was actively buying the debt of reckless companies that the market had already judged as high risk or even insolvent. That sounds less like monetary policy.
Or more like fiscal policy.
Exactly. It sounds like allocating credit to specific companies or industries.
That's the line that was crossed. Monetary policy is supposed to affect the price and availability of money broadly. Fiscal policy, which is the domain of Congress, involves taxing and spending. It involves deciding where credit should be allocated, who gets the capital.
So when the Fed starts buying junk bonds...
When the Fed starts purchasing junk bonds to stabilize the corporate credit market, it is making decisions about corporate survival. It is essentially performing a fiscal function. This expansion creates the severe risk of what's called debt monetization.
Debt monetization, what does that mean exactly?
It means if the asset purchases are too large, or if the assets are never fully removed from the balance sheet, the Fed is effectively paying for new government spending or subsidizing corporate borrowing with newly created money.
And historically, we know that debt monetization is strongly associated with high inflation and the destruction of central bank independence.
Absolutely. Just think back to the post-World War I and World War II eras. During those times, the U.S. Treasury basically dominated the Federal Reserve's decisions to ensure favorable financing for government bonds.
The central bank was subservient.
Completely. When the New York Fed tried to raise rates in 1919 to cool inflation, the Treasury Secretary threatened their leadership. The lesson is timeless. When the central bank becomes the guaranteed financier for either the government or systemic corporate debt, it compromises its core mission of maintaining price stability.
When we talk about these decisions being made, we have to address the elephant in the room, the erosion of technocratic neutrality and the whole revolving door issue. It's difficult for the public to believe these decisions are purely neutral when leaders often cycle between central banks, investment banks, and private equity.
It creates a self-reinforcing structure. Of course it does. When central bank leaders have deep personal and professional ties to Wall Street, as many do, with backgrounds in investment banking and private equity, the policies enacted, while they're framed as being about systemic stability,
They just happen to align perfectly with the interests of the financial institutions they came from.
They often do. For instance, purchasing corporate bonds directly props up the value of those securities held by private equity and investment banks. The policy outcomes mirror the interests of the financial class. It ensures that systemic risk is socialized while financial profits remain privatized.
This sounds like a structural issue more than just a political one. The critique we often hear is that we are no longer governed by transparent laws, but by an administrative bureaucracy making decisions behind closed doors.
Right. And this is where the critique of the managerial state comes in.
The managerial state.
It's a profound philosophical critique of modern governance, articulated by thinkers like Paul Gottfried and Samuel T. Francis. It's this idea of a permanent, entrenched bureaucratic regime that remains in power regardless of the election cycle.
And how does this relate specifically to central banking?
Well, the managerial state operates by justifying its continuous power through abstract, sometimes ill-defined goals like equality or social justice, or critically, economic stability.
So it maintains power through administrative decree.
And social engineering, yes. When the central bank, an unelected body of highly credentialed technocrats, begins to allocate credit, deciding which companies live or die, or which asset classes deserve support, it is acting as a tool of this managerial elite.
It's substituting its own judgment for the rule of law.
It's administrative, opaque judgment for the transparent, traditional rule of law. The managerial state replaces limited government with an unlimited state, where the central bank's mandate extends far beyond simple price stability and into the realm of fiscal planning and social outcomes.
This takes us to Francis's related concept, anarcho-tyranny. That term sounds jarring, but it seems to describe the financial landscape perfectly.
It's a powerful phrase. Anarcho-tyranny describes a scenario where the elites concentrate state power. That's the tyranny on law-abiding citizens, often through excessive regulation or, in our context, unfair economic competition like the one Julian faced.
While at the same time,
Simultaneously, the state allows basic, core functions, like protecting the market from reckless insolvency, to go unenforced. That's the anarchy.
so applied to finance.
Financially, this means the state is tyrannical in its micromanagement of the economy and credit allocation, constantly making these arbitrary choices about winners and losers. That's the tyranny. Yet it allows reckless financial behavior to flourish, knowing it will simply stabilize the structure when it inevitably collapses. That's the anarchy.
So Julian, the prudent, law-abiding business owner, faced economic tyranny from a competitor propped up by the system.
While the competitor's recklessness, their financial anarchy, was rewarded, the lesson is clear. When technocratic bodies respond to populism or political pressure by engaging in credit allocation, they lose their neutrality. And the cost is the destruction of market discipline.
So we've established that the mechanism of new money creation favors financial insiders, the Cantillon effect, and that central bank activism rewards recklessness over prudence, which is moral hazard.
Right.
Our final deep dive segment has to address the most pervasive and insidious consequence, the silent tax of inflation and its effect on the bedrock of society, the family unit.
This is where it gets deeply personal for people.
It really does. This is the story of Clara's letter, a truly heartbreaking account of intergenerational theft. Clara was settling the affairs of her late father, a disciplined, blue-collar worker from the mid-20th century.
A classic saver.
A religious saver. He believed in thrift, putting away a portion of every paycheck into standard, stable accounts. He was intending to build a secure nest egg. He saw it as the social glue, a guarantee that his grandchildren wouldn't start their lives burdened by debt.
Admirable goal.
Yet, when Clara finally accessed those accounts, she realized that the fiat currency debasement of the last 2 decades had transformed what should have been a modest fortune into a pittance.
Wiped out.
The wealth her father sacrificed his youth to build was effectively evaporated by deliberate inflationary policies. And the result? The younger generation, instead of receiving a start in life, was forced into high-interest debt just to manage basic survival.
So inflation is far more than an inconvenient rise in the price of milk.
It's a structural mechanism that dissolves long-term savings and steals intergenerational stability.
Clara's experience perfectly encapsulates the true social cost of currency debasement. Let's start with a precise definition. Debasement historically meant literally lowering a currency's intrinsic value.
Right, with gold or silver coins.
Exactly. A government would mix the precious metal with base metals, maintaining the face value while shrinking the real purchasing power. And governments pursued debasement throughout history for a very simple reason: to fund massive obligations, usually wars or infrastructure, without enduring the political pain of raising visible taxes.
It's an invisible tax on everyone holding the currency.
That's all it is.
The history of debasement is littered with spectacular failures. Can you walk us through a couple of those historical precedents to show how this process played out before our modern fiat system?
Of course. The collapse of the Roman currency is perhaps the most famous long-running example. Emperor Nero began the process of debasement around 60 AD. He reduced the silver content in the standard Roman coin, the denarius, from 100% to around 90%.
A subtle theft.
A very subtle theft. But once the process started, it became addictive. As Rome's expenses grew and its silver supply stagnated, successive emperors accelerated the debasement. By the year 265 AD, the silver content had plummeted to a terrifying 0.5%.
Wow. Functionally useless?
It had become a base metal token stamped with a promise that everyone knew was false. It destroyed internal trade, forced a retreat back toward localized barter systems. It was catastrophic.
Or, even more dramatically, the Weimar Republic after World War I.
The Weimar Republic printed money aggressively to pay war reparations and other obligations, leading to one of the most severe hyperinflations in history. The mark went from about 8 per US dollar to 4.2 trillion marks per dollar.
Trillion.
Savings were wiped out overnight. People who had worked their entire lives and saved prudently suddenly found their wealth could barely buy a loaf of bread.
And in the modern era?
In the modern era, since our currencies are fiat-backed only by government decree, debasement occurs when a central bank electronically creates money without a corresponding increase in real economic output. The consequence is systemic inflation, silently eroding the value of every currency unit you hold.
Now, let's connect this theft to family structure. You mentioned studies showing changes in marriage, fertility, divorce rates since WWII. How does monetary policy filter down to affect deeply personal decisions like having children or staying married?
The link is fundamentally about financial uncertainty and what we call time preference.
Time preference.
Studies have shown for a long time that financial tension, deceit around money, chronic insecurity, these are top predictors of divorce. When the value of your labor and savings is constantly being eroded, it creates massive financial tension within a household.
Makes sense.
Furthermore, central bank policy directly manipulates our time preference. Time preference is just our willingness to delay gratification. When a central bank suppresses interest rates, driving them artificially below the market's natural rate, it creates a massive disincentive to save.
So saving becomes a financially punished activity. If you know your money will be worth less next year, why save it?
Precisely. The rational actor in that environment is told, don't save for the future, consume now. This fosters a pervasive culture of short-termism. We prioritize immediate consumption over future planning.
And what's the ultimate long-term plan?
Raising children. Raising a child is a 20-year commitment that requires stability and deferred consumption. If the financial system constantly punishes deferred consumption, it makes a calculation for long-term investments, like having a family, much, much less attractive.
Is there data on that?
There is. We find a documented positive correlation between real interest rates and total fertility. Higher real rates encourage saving and future planning, which supports family formation. Suppressed rates do the opposite.
We also saw that instability reflected in the spiking divorce rates during the inflationary 1960s and 70s. Was that purely financial, or were there other social changes involved?
It was a complex confluence, of course, but the financial stress was a massive factor. The inflationary environment, fueled by the Vietnam War and the eventual abandonment of the gold standard, put immense pressure on middle-class households.
So it was the wrecking ball.
While changes in no-fault divorce laws created an immediate spike, research suggests those marriages were already fragile under the financial strain. Inflation acted as the wrecking ball. And the subsequent decline in divorce rates we see today, particularly among the middle and lower economic classes.
That's a good thing, right?
Well, some sociologists and economists interpret that not as a sign of restored stability, but as the liquidation of marriage among those cohorts.
That is a harsh term, liquidation of marriage. What does that even imply?
It implies that the traditional structure of marriage has become bifurcated by economic class. Those who are winning in this financialized economy, typically dual income, college-educated couples in stable, high-value industries, they maintain traditional, stable family patterns. They are insulated from the worst of the volatility.
But for the working and lower middle classes,
For them, where incomes are unstable and wage growth lags far behind asset inflation, the traditional economic rationale for marriage pooling resources for security has dissolved. If a young man is in an industry with low potential income growth, he's simply not seen as a reliable candidate for sustainable household formation
so monetary policy is exacerbating class segregation.
and eroding the financial base necessary for the middle class to maintain traditional family structures.
If saving is financial suicide and wages can't keep up with asset inflation, then the only rational response for the individual is to get into debt and leverage assets as quickly as possible.
This creates the culture of indebtedness.
It seems inevitable.
It is the inevitable psychological shift. Central bank policies create a kind of moral hazard that trickles down to the individual. When the cost of borrowing is suppressed and the value of currency is constantly eroding, prudence is punished. The rational advice is always leverage into real assets, like housing, as early as you can and with as much credit as the bank will allow.
This frantic pressure to get in early and with as much leverage as you can, it must breed fragility.
Profound financial fragility at the household level. People are forced into maximal risk just to stay even. And this high-risk behavior, it extends beyond mortgages. We see it in other forms of speculative behavior.
Like what?
The inflation culture encourages increased individual risk-taking. We see people leveraging credit cards to try and flip luxury goods, engaging in aggressive day trading with borrowed money, or turning to high-stakes sports gambling in a desperate effort to hit it big and outrun the debasement treadmill.
They're internalizing the lesson of the financial system.
They are. And the lesson is that the rewarded path is not slow, steady saving, but leveraging debt into assets. This complicated high-risk indebtedness profoundly destabilizes the foundation needed for sustainable, low-stress household formation.
The system is designed to reward debt and punish the very prudence and planning that built the social stability of the previous generation. It truly is a silent tax that corrodes the social glue from the inside out. So we have spent this deep dive tracing the invisible architecture of the modern financial system. We saw how monetary expansion distorts meritocracy, ensuring that David, the productive civil engineer, could never catch up to his financial insider neighbor.
Because the Cantillon effect directs the newest wealth to asset owners first.
And we established how systemic bailouts and central bank activism erode market discipline, punishing Julian's prudence while rewarding his reckless competitor with these so-called therapeutic interventions.
Which is a reflection of the managerial state in action.
And finally, we saw how currency debasement acts as a silent systemic tax, stealing the intergenerational security that Clara's father sacrificed his life to build.
By enforcing a culture of short-term indebtedness and financially fracturing the family unit.
So what's the final takeaway?
The key takeaway is this. The modern financial system is profoundly structured to keep you in motion. The tools of central banks, interest rates, liquidity injections, asset purchases, they're not neutral. They're designed primarily to stabilize markets, protect institutions, and preserve the fragile, debt-fueled architecture of the economy, often at the expense of those furthest from the money spigot.
So when the next crisis comes,
When the next inevitable crisis arrives, the central bank will do what it always does, protect the system.
your power then, as the listener, lies in knowing this structure. Financial education is the ultimate defensive measure. Knowing how money works and how central banks enforce this structure allows you to position yourself outside of its destructive reach.
This means focusing on learning, simplifying your financial life, diversifying away from concentrated systemic risk, and owning things that matter, rather than chasing growth fueled by endless debt and consumption. That growth is a treadmill designed to keep spinning, and the faster it spins, the harder it is to stop. You must protect yourself from its predictable cycles.